The playbook started after the last crash. To understand the $500 billion bet, we go back to the cleanup. The origin story, how Wall Street entered your block. Homes sat empty by the tens of thousands after 2008. Foreclosures piled up faster than banks and Fannie or Freddie could process them. Lawns went brown. Notices curled on doors. In that glut, a new idea took shape. Buy scattered single-family homes in bulk, renovate just enough, and rent them out like an apartment building stretched across a map. Traditional landlords had long said single-family rentals didn't scale. Too many roofs, too many driveways, too many different water heaters. But conditions were different. Prices were distressed. Interest rates hovered near zero. Software could track what clipboards never could. Cheap money and cheap houses formed the base. Property management tech, the ability to route work orders, dispatch contractors, and standardize renovations, promised a path to scale. Suddenly, scattered sites didn't look like chaos. They looked like a portfolio. Blackstone moved first and loudest, rolling up tens of thousands of houses into what became Invitation Homes. American Homes 4 Rent and Progress Residential followed, each with its own thesis but the same ingredients. Acquire fast, fix light, stabilize rent, refinance, repeat. Federal policy made it possible. Quantitative easing and near-zero rates flooded the system with capital searching for yield. Agencies and banks experimented with bulk sales of foreclosed REO properties. Local tax lien auctions added another stream. What had been retail, one house, one buyer, shifted toward wholesale. Geography mattered. Operators weren't just buying houses, they were buying school zones, commute times, and HOA rules. The Sunbelt offered something rare: newer housing stock, consistent layouts, and logistics-friendly access. Phoenix cul-de-sacs. Atlanta subdivisions near warehouse corridors. Charlotte rings with strong schools and growth. Clustered purchases meant one maintenance team could cover 20 houses before lunch. In the spreadsheets, that translated to lower cost per ticket, faster turns, and fewer days vacant. Buying cheap wasn't the endgame, it was the beginning. The real play was to hold and monetize, which meant solving management at scale. Early days were rough. Tenants sat on hold. Work orders looped through call centers. Contractors no-showed. Critics pointed to horror stories as proof the model didn't work. Inside the firms, engineers and operators iterated. They tagged components with QR codes. They standardized paint colors, appliance brands, flooring SKUs. Turn crews knew exactly what pre-move-in meant in each submarket because every home shared the same spec. Repairs got faster. Vacancies shortened. Financing evolved in parallel. Warehouse lines from big banks extended acquisition speed. Once rent stabilized, short-term debt rolled into term loans. Then came the innovation that turned rent into bond coupons. Single-family rental securitizations. Thousands of leases pooled together, their expected cash flows sliced into tranches. Ratings agencies graded them. Insurance companies bought the safest slices. The rent check a family mailed in Phoenix was now part of a bond, paying a fixed return to a fund in Toronto. Underneath was a simple yield equation. If a $300,000 house rented for $2,200 a month, that grossed roughly $26,400 a year. After vacancies, maintenance, taxes, and fees, maybe net operating income landed around $17,000, a cap rate near 5.7%. If financing cost 4% and operators squeezed expenses with scale, the spread looked attractive. Crucially, models assumed rent growth, 3% for percent, sometimes more, compounding over years. Renewal strategies, ancillary fees, and capex-driven rent resets weren't extras, they were required inputs. Speed still mattered. Organic one-by-one purchases were slow, so roll-ups accelerated. Operators struck deals with builders to pre-purchase phases, what we now call build-to-rent. Uniform floor plans and centralized amenities lowered operating costs and made pricing consistent. They tapped iBuyers, Opendoor, OfferPad, Zillow offers when active, as instant inventory pipes. Algorithmic offers scooped houses. Institutional buyers took them in bulk at a discount, trading top dollar for speed and certainty. Appraisal headaches disappeared. The machine fed itself. On the ground, families noticed. A couple with FHA pre-approval would book a showing, only to learn an all-cash offer had closed in days. Bulk buyers didn't haggle over repairs. They shaved price for speed and waved the appraisal risk away because there was no mortgage. Title companies got used to seeing the same LLC names. Postcards started arriving at distressed addresses. We buy houses, close in 7 days. For sellers needing certainty, the speed was hard to refuse. Local governments were torn. Abandoned homes hurt property values and tax rolls, but an owner-occupant base had long been the civic backbone. PDAs, neighborhood watches, steady school enrollment. Inventory needed to move, and the big buyers could move it. Pilot programs tested selling pools of foreclosed homes to qualified buyers who promised to rehab and rent. The pitch: stabilize neighborhoods now, revisit ownership later. The thesis hardened. Distressed assets plus cheap money plus software-enabled management had created a new asset class: single-family rental at institutional scale. Skepticism about scattered site gave way to dashboards with KPIs. Average days to turn, maintenance cost per door, renewal rate by submarket. The human experience stayed messy, but the machine learned. One detail from those early days would matter later: concentration within specific zip codes and school catchments. It wasn't random. Operators drew heat maps around where families wanted to live, but struggled to buy. Near good schools with workable commutes in tidy HOAs. That concentration meant comps began to reflect investor behavior as much as owner-occupant preferences. When clusters of corporate landlords set renewals at similar levels and synchronized resets at turn, the baseline moved. Appraisers and lenders watched a quiet shift. Homes evaluated for income potential alongside sale comps. Not universal, not overnight, but within portfolios, underwriters looked at net operating income, not just granite countertops. The perspective changed. A 3-bedroom wasn't only worth what a neighbor paid, it was worth what a family could reliably be charged over the next 5 years. Those early acquisitions set the template for everything that followed. Buy fast, cluster tight, standardize everything, smooth the cash flow, assume rent growth. The neighborhood changed subtly. Fewer porch lights stayed the same for decades, more for lease signs flipped every couple of summers. The recovery from the crash had a new landlord, and it didn't live on the street. The $500 billion bet mechanics. The money didn't arrive in a suitcase. It arrived as promises layered on top of other promises. At the top were pension funds and sovereign wealth, slow capital that wanted steady checks, not drama. They committed to private equity managers who built operating platforms with software, call centers, and regional teams. That structure insulated retirees in Ohio from a leaking dishwasher in Orlando. It also imposed discipline: quarterly targets, audited KPIs, and growth plans measured indoors. Leverage turned discipline into velocity. Operators opened warehouse lines with big banks, revolving credit that let them close on houses in days. Once a batch of homes was leased and humming, short-term lines rolled into term loans. Then came the real engine: single-family rental securitizations. Thousands of monthly rent payments were pooled and sliced into tranches. Ratings agencies rubber-stamped risk tiers. Insurance companies and bond funds bought the safest slices for predictable yield. A rent check in Phoenix became a bond coupon in Toronto. The alchemy worked because the fees, vacancies, taxes, and repairs could be forecast at scale. Underneath was a simple spread. A $300,000 house renting at $2,200 a month grossed roughly $26,400 a year. After vacancies, taxes, insurance, maintenance, and platform fees, maybe $17,000 landed as net operating income, about a 5.7% cap rate. If debt cost 4% in a zero-rate world and scale shaved expenses, the difference looked like profit. But the model assumed more: baked-in rent growth, 3%, for percent, sometimes higher, compounded. Renewal uplifts, fee stacks, and capex-driven resets weren't gravy. They were necessary inputs to keep coverage ratios and bond triggers comfortable. Scale demanded speed. Buying one house at a time wouldn't feed the machine. So platforms stitched pipelines. Builder partnerships pre-sold entire phases, build to rent, where every floor plan matched, every part was standardized, and amenities could be folded into resident services fees. iBuyers, Opendoor, OfferPad, and for a time Zillow Offers became instant inventory sources. Their algorithms bought from homeowners with certainty. Institutional buyers took clusters in bulk at a discount. Appraisal risk evaporated. Closing calendars tightened. Warehouse lines funded the tap, and securitizations refinanced the bucket once it filled. Inside the portfolio, Managers tuned with a pilot's touch. Zip codes were treated like products. Underperforming homes, older systems, weak school zones, stubborn maintenance were culled. High-yield doors were held and surrounded with more of the same. Dashboards tracked lead-to-lease conversion, days vacant, renewal capture, and ancillary income per occupied home. If renewal rates dipped in a school catchment, a playbook triggered. Targeted capex at turn, a smart home package, new photos, and a rent reset that rippled through comps. Decision cycles shrank from months to weeks. So why call it a $500 billion bet? Because that's the rough scale when you add what's already owned, what's committed as dry powder, the credit capacity on warehouse lines, forward purchase agreements with builders, and smaller portfolios slated for roll-up. Each layer reinforces the next. More houses mean better data. Better data raises confidence in underwriting. Higher confidence lowers the cost of capital. Lower costs justify higher bids. Higher bids win more houses. It's a flywheel powered by rent growth expectations and funded by investors who prefer smooth lines on a chart. Smooth lines require engineering. Renewal teams stagger lease expirations to avoid floods of vacancies. Pricing tools serve three options: stretch, base, defend, and reps start high, then step down on a schedule. Fees carry water: pet rent, smart home bundles, utility processing, resident benefit packages. Individually small, together meaningful. They lift effective rent without spiking the headline number that public trackers notice. Concessions are structured, 1 month free on 13, to keep reported base rent firm for securitization tests. Debt terms push behavior, too. Securitizations come with covenants. Occupancy floors, debt service coverage thresholds. Miss them, and cash gets trapped in reserves until metrics recover. That pressure travels down the org chart. Regional managers are tasked with collections timelines, late fee schedules, and renewal capture. Filing on day 15 instead of day 30 isn't personal. It's compliance with a waterfall that pays bondholders first, then operating costs, then everyone else. In quarter-end weeks, decisions hardened. Builders adjusted their playbooks. Selling 200 homes to one buyer meant predictable closings and fewer sales reps. Subdivisions were designed with service in mind. Meter placements, standardized parts, paint codes, even landscaping specs that aligned with preferred vendors. Amenities moved behind an app, creating fee-ready features and brand continuity that justified uniform pricing. The operator didn't just buy roofs. They bought a captive demand funnel with consistent comps. Smaller landlords felt the edges. Their cost of capital was higher, their repairs less standardized, their vacancy risk concentrated. Competing with a platform that could ride a soft quarter while still passing bond tests was hard. Many matched fees to survive, more sold into the roll-up. Appraisers and brokers, seeing rent rolls and securitized portfolios, leaned into income narratives in certain submarkets. A house wasn't just a comp, it was an annuity. From a distance, it looked tidy: capital in, houses acquired, rent collected, coupons paid. Up close, it was constant calibration: pricing, fees, filings, capex at turn, animated by a core belief that rents would keep climbing steadily enough to satisfy lenders, ratings committees, and investors who never planned to visit the cul-de-sac their yield depended on. How rents get engineered upward. Inside the platform, rent isn't a number, it's a live experiment. Every application, renewal, concession, and maintenance ticket flows into a pricing engine that learns the shape of demand at the block level. Instead of public comps, operators rely on their own signed leases, thousands of them, tagged by school rating, commute time, lot size, and recent capex. When renewal season approaches, the system generates 3 offers for each door: stretch, base, defend. Reps start with stretch, watch for pushback, and step down on a script. The goal isn't a perfect price. It's a predictable lift. Timing is part of the choreography. Leases don't all end in June anymore. Expirations are staggered across months and days of the week to avoid vacancy clusters in any zip code. 90 days out, an email lands with a pre-filled increase tied to market alignment. If there's no response, the call center follows with talking points tailored to the likely household: a family tethered to a specific school, a night shift nurse, a remote worker. The message is subtle: stay, and life stays stable. Move, and you reset the calendar and the commute. Headline rent is only half the story. The fee stack carries quiet weight. Pet rent per animal. A smart home package bundling a keypad and thermostat that's standard, no opt-out. Utility billing with a processing line item. A resident benefits package that folds in. Credit reporting and portal access. Each fee is small enough to feel tolerable, but together they lift effective rent in ways public trackers miss. Internally, it prints as clean growth, ancillary income per occupied home up, month after month. The turn is where resets are engineered. Between tenants, a light capex burst, vinyl plank instead of carpet, mid-tier stainless, a fresh coat of standard gray, creates justification for a higher ask. Fresh photos push the listing to the top of portals. The pricing engine updates comps across nearby homes owned by the same operator, so a single decision to spend $4,000 at turn can support a $100 to $150 monthly bump. Multiply that across a cluster in one school catchment, and the floor ratchets without a single dramatic leap. Renewals focus on friction. The model doesn't need everyone to stay. It needs the right people to stay. Families with kids near testing or seniors relying on nearby care are less likely to move. The system recognizes those anchors, lease history, school calendars, service requests that mention bus stop, and pushes higher initial offers with smaller discounts. Break lease fees, 60-day notices, and precise move-out inspection windows add just enough drag to make staying rational. Moving costs aren't just money, they're disruption. The platform prices against that. Screening criteria shape the applicant pool toward households that absorb increases. Minimum income multiples rise a notch in favored zones. Stricter pet rules and higher credit thresholds filter applicants to those less likely to churn. By the time a listing goes live, demand is curated for homes with the most pricing power. Decent parks, tidy HOAs, strong schools, limited new for sale stock. It's not collusion. It's controlled scarcity, zip by zip. Seasonality is engineered. New listings skew towards spring and early summer, when days vacant drop and concessions vanish. Off-season renewals soften, maybe a smaller bump, maybe a one-time $250 credit, but the fee stack steadies the net. Even when a concession appears, it's structured. 1 month free on a 13-month lease, which keeps reported base rent firm in securitization reports. Public indices see discount. Bond math sees stable. When the dashboard senses softness, longer days on market, fewer tours to application, rising inquiry to approval fallout, adjustments are surgical. Pricing shifts in $25 increments. Listing photos are refreshed. A targeted capex refresh goes to homes with too many showings and no apps. Marketing dollars widen to portals with better lead-to-lease conversion for that submarket. In weekly stand-ups, regional managers compare whether a smart lock bundle or a pet amenity credit lifted acceptance more. It's A/B testing applied to shelter. Maintenance is folded into revenue protection. Fast fixes around renewal time aren't just service, they're rent defense. Non-safety repairs on homes likely to turn often slip to post-move out, when costs can be capitalized and the rent reset can absorb them. If an eviction is likely, non-essential tickets pause. None of this shows in a glossy deck, but it flows into net operating income, which feeds debt service coverage, which sets room for next quarter's offers. Across a neighborhood, this microengineering aggregates into comps. When an operator controls dozens of doors near a single school, its internal resets become the de facto market. Small landlords, priced out of volume discounts and spooked by rising insurance and taxes, peak at listings and follow the fee stack to stay solvent. A pattern emerges, not identical prices, but similar effective rents and similar add-ons. The street looks competitive, the spreadsheet reads convergence. The public sees cranes and reads headlines about rent growth cooling. Families feel none of that in the 3 zip codes that matter for their kids. A $50 increase across 2,000 homes in those zones offsets big discounts downtown. Operators don't need to win every negotiation. They need to keep the line smooth enough for lenders and ratings committees. That means keeping base rents firm, using concessions as camouflage, and reserving real drops for homes that won't set comps. The machine counts on one simple truth. People move less than models predict, especially when school calendars and commutes structure life. The platform exploits that gently but relentlessly, through timing, fees, curated demand, and small, constant resets. Rent doesn't rise by accident. It rises by design.